So now, Whitney, I'm going to embarrass myself here. You're from Ohio?
I'm from Ohio, yes.
Well, which part of Ohio? Like the fancy northern part or the country southern part? That's how Ohio is, right?
Sure. I don't think any part of Ohio is fancy, but I'm from Columbus. I'm from right in the middle.
Okay. It's a sophisticated place, big city. Now,
the finest tractors.
Are horses a big thing in Ohio?
Horses are a big thing everywhere. They're large.
Well said.
It's all relative.
I should say, are they an omnipresent factor in life in Ohio?
Not in the cities.
Okay. Because you can imagine in Texas, it's not that horses are everywhere, although you could probably go several months without seeing a horse every day if you left your house enough. But they're definitely horses are, metaphorically speaking, in the water. I imagine sometimes they are in the water as well, but it's just there they are. Horses.
What's the source of this knowledge?
Wait, the knowledge that I have? Or...
Yeah, I mean, you're just speaking like you know a lot about horses and where they are.
Oh, I don't know.
I want to know how you know this.
More of the knowledge that I do have is having grown up in Texas, and I just remember there being horses. I don't know anything about horses other than don't stand behind them and they like apples or something like that.
Like growing up, when you go to your friend's house, do you just they have horses there? Is that what
no, not my friends, because we were like your Columbus people. We were fancy city slickers. But the cops would ride horses around. You would go if you're a kid on the weekend, you go to some kid thing
You're not convincing me, Coté.
you go to Pioneer Town, and they've got horses there, and there'll be a parade with the cowboys and the horses. You go to the rodeo. You go drive out to your dad's house who lives in Georgetown. You pass by a ton of horses. Just horses everywhere. And
I have an important question. Why are we talking about horses?
Well, that is because I'll tell you why we started off with horses, because of our guest. Why don't you introduce yourself briefly, guest?
Guest. That's my name now. I'm Rachel Chalmers. Coté and I go way back. I am Australian, as you can hear. I've been in Silicon Valley for about 25 years now. Started out as an analyst, which is where I got to know Coté. I built the software infrastructure practice at 451 Research, which we sold to Standard & Poor a few years ago. Got recruited into the dark side of venture capital, where I've been for the last dozen years, most recently at Generationship, a fund that I've raised with Michelle Yee, who was the lead engineer on IBM Watson when it went on TV and won Jeopardy. And the reason we're talking about horses is because that's really all I talk about or think about, as Coté well knows.
That's right. And I think as you put it once, you decided to get into venture capital so that you could buy more horses.
That's exactly right. That's what tempted me over to the dark side.
VC is Rachel's VC for horses.
Yes, it's my investment vehicle. I can make this relevant. Watch this. So when I was growing up, when I was a little kid and I was in love with horses, we had this idea about how horses related to each other, with the wild stallion at the pinnacle of the pack and then everything in a hierarchy below them. Now, if you followed anything about the psychology reproducibility crisis, about rats getting addicted to cocaine or alpha wolves, you may know that those experiments have proven to be unreproducible. Wild animals in a state of abundance don't naturally form hierarchies. Rats, if you put them in a lovely rat park with lots of enrichments in their enclosures, don't get addicted to cocaine. They drink water instead of cocaine. The same thing has happened in our understanding of horse behavior. There's a very prominent ethologist I love called Lucy Rees, and she has found that horses in the wild, you're going to love this, live in matriarchies. And it's not even enforced. So a horse has a very different sensory realm than a human. They're prey animals, and so their eyes are on the sides of their heads. They've got nearly 360-degree view. They're constantly scanning the horizon. And they actually behave a little bit more like meerkats. The alpha mare is just the one who's on duty at the time, or who knows that it's time for everybody to get hydrated, so she leads you down to the springs. And they trade off all the time. There's always a horse in the herd who's paying attention. And then and everybody else is paying attention to that horse. And then when that horse senses danger, when there's a mountain lion, it starts off and everybody else follows in a herd. Horses are also extremely generous. So they have this very different sensory world from us. They have this very different physical body. They're much stronger and more powerful and have a lot more endurance. When you learn to ride well, the horse actually invites you into that gestalt entity of the herd. It invites you to share its sensory world and its physical strength. And that's why riding is incredibly magical. And that's why so many of the skills I've learned trying to be a good equestrian translate directly to my practice as a VC, where I'm trying to find teams that are more than the sum of their parts.
So what's an example of something you've learned from a horse, that a skill you've learned from a horse that translates?
The centaur that is a horse and rider together. Sharing the rider's intellect and the horse's physical strength, and the horse's intellect and the rider's ability to sit still, is a different thing from either a horse or a rider separately. So different that it shaped the course of our civilization. Like the reason we still talk in horsepower, the reason national boundaries are drawn where they are, is because of mounted warfare in many cases. In the same way, when you meet two co-founders of a software startup, and this sounds really dorky, but it's so true.
I'm here for it.
If you meet two founders who can finish each other's sentences, who can pick up when one of them is stuck, who can have 5 good interactions to every one challenging interaction that they have together, those two people have formed a gestalt that is more than the sum of their parts. And that can be the seed of forming a company that creates more value than it ingests, which is all venture capital is about. It is trying to put money to work where it will be multiplied into more money.
I have so many questions about one of which is Coté promised to embarrass himself as the first words that came out of his mouth this podcast. What part of what just happened was embarrassing? It was lovely.
Oh, that I didn't remember for sure if you were from Ohio or not.
Oh gosh. So I don't know a lot about venture capitalism at all. So a little bit of this podcast is going to be a 101, or just me asking a ton of questions about how it all works. So
which is great, because more people should know about how it works. It should be democratized. It's not magical. There's no secret wisdom that VCs have. Everybody should have access to this.
So for one thing, you said you were an analyst and got recruited to be a venture capitalist. That already goes, I kind of pictured venture capitalists as being people who were rich already. Just like,
yeah, no, that's fair. So venture capital has traditionally been enormously hierarchical.
Okay.
It started out being very rich people or the scions of very rich families, putting money to work in high-risk enterprises. So that was the inception of venture in the Valley. So for a long time, it was very rich people. You would do your stint as an operator, and then you would sell out of the company and you would go and invest that money as a VC. And that's still very often true. If you look at the general partners of venture firms, tons of them didn't come up through venture. They had a long stint at Microsoft, or they started their own company like Mark Andreessen, and they became general partners of funds. Now, there are VC partners and there are VC partners. There are the general partners who typically commit some of their own wealth to the fund. It's typically 1 to 2%. So if you have $100 million fund, you as the GP are on the hook for $1 million to $2 million. And then there are the employee partners. So you can start in a venture firm as an associate or a principal, work your way up through vice president and become a partner that way. As you might imagine, when you're sitting in the boardroom making decisions, the GPs who have their own money on the line and who raise the fund get a very different vote from the employee partners who are there on salary.
Absolutely. And so when you got recruited, like, what's your career path look like through this picture you just painted for me?
Hilarious. As you have probably already gathered, I'm kind of weird, and I particularly don't fit very well into very hierarchical environments. So venture firms and accelerators keep like wooing me because I'm noisy and I've had some good investment outcomes. And then like I try to mesh my working style with theirs, and they're confused by me and I'm confused by them. And so after this had happened 3 or 4 times, I finally accepted what the universe was trying to tell me and raised a fund of my own so that I could be the GP and make the decisions.
Okay. So how does someone who, wait, first, is it okay for me to ask, like, do you come from money? Were you rich to begin with?
That's a really complicated question. No, I wasn't. I absolutely wasn't rich to begin with. I come from, I'm Lizzie Bennett. So my father came from family money, but didn't have any. He was a distressed gentleman. And when I say family money, he was an engineer. His father was a military officer. His grandfather was a coal miner, and they'd sort of made fortunes and lost them along the way. And my dad was on one of the losing them cycle. My mother was a working class woman from Warrington, which is in the north of England. And both my dad and my mother were huge influences on how I think. So I come from money in that I have very expensive tastes like horses and architecture and old books, but not in the sense that I had any capital at all of my own.
So then how does someone who doesn't already have capital, like if you decide to make a fund, like what do you do? What's your first step?
Shout out to VC Lab. It's an accelerator for emerging managers. Michelle and I went into the program with no fund and we came out of it with a fund. So I ran the VC Lab playbook, which is industry changing. Mike and Adeo, who run the VC Lab program, are responsible for a large part of my success with Generationship, and I'm hugely grateful. So what they had me do was get on the phone with everyone I've worked with in my career. And because I was an analyst and then a employee investor, I made a lot of money for a lot of people. And there were a lot of people that I had worked with briefly who wanted to work with me more. It ended up not being close friends of mine that were really rich because they were like, oh, Rachel, whatever. It was people one step away who were like, I've always followed you and I've always been really interested in what you're working on and I'd love to be more closely connected with you. I got them to sign a document called a pact, which is not legally binding, but it's like, tell me more about this fund that you're interested in raising. And I ended up getting 40 people to commit money to a new legal entity, which is the fund. And I will be calling their financial commitments in 4 tranches over the next year or 2. And I will invest that money directly into technical women building software infrastructure around the AI platform shift. So it's really just this big sales process of telling a whole bunch of people, I know how to put your money to work in this very dynamic and exciting market.
I understand your horse analogy now more than I did when you were actually saying it. not the horse and rider, but the leading the herd. Pack. Yeah, the herd.
Oh, I hadn't even thought about that.
Oh no!
But yeah, I'm taking my shift as like I'm the one who's in the thick of it, paying attention, looking out for changes in the environment. That's actually very accurate.
And when you run towards something, everyone else is going to run with you. Yeah, it's exciting. And I love that the thing you're running toward is as women founders in infrastructure.
That was a really deliberate choice. So of my big investing successes, the 3 I love the best are Launch Darkly, Aviatrix, and Honeycomb. And I don't know how familiar your your listeners are with these companies, but Launch Darkly was founded by incredible badass Edith Harbour, who used to run the Western States Trail, which is 100 miles up and over the Sierra Nevada. Aviatrix was founded by Sherry Way, who's an incredible super genius networking software engineer. And Honeycomb was founded by Christine Yan and Charity Major. And if you don't know who Charity Major is, crawl out from under your rock. So these 4 women just like phenomenally overachieved over the last 10 years. Those 3 companies together are collectively valued at over $6 billion. Because I was lucky enough to meet them early, I saw how many doors got slammed in their face. I saw VCs say, no, I'm not going to write them a check because Charity doesn't fit my stereotype of a founder CEO. And I was just filled with the conviction that these women are systemically undervalued at pre-seed and go on to outperform against the market. And that's the thesis around which we built the fund.
And so what, pick one of those women in one of those companies, please, and tell me, like, how do you come to get to know someone? How do you hear about them first? Do you meet them in person? Is it like Shark Tank where they like come give you a pitch? Like,
yeah,
how do you find them?
All those different ways. So I met Edith because she was going through the Alchemist Accelerator, which I was involved with from very early on. I met Sherry through one of the funds that I was working with. Charity is the best example because I had a thesis in my head. I had covered VMware and Splunk as an analyst, and I saw that VMware greatly multiplied the number of servers under management. And then Splunk came in and made it possible for an individual sysadmin to manage 10 times as many servers. I was lucky enough to invest in Docker early on. I saw containers proliferating the way VMs had 10 years earlier. I knew that we would need some higher dimensional way of visualizing and understanding the behavior of this proliferation of containers. Mm-hmm. So when I met Charity and she said I was at Facebook, they had this tool called Scuba, which was a columnar log and let you ask ad hoc questions about the state of your infrastructure. I was like, that's it. That's the thing that I've been looking for. We met, she was pitching me, and then we moved along to the Elbow Room on Valencia, RIP, the Elbow Room on Valencia, and we had cocktails and we haven't stopped talking since.
That's amazing. So in that case, it was more like, okay, you feel the pulse of the market. You kind of know where some holes are. And then someone comes along who has the right idea that you kind of probably already knew about, at least like subconsciously, right?
That's the perfect scenario. It doesn't always work that way. But like the reason Honeycomb is so memorable to me is because the stars aligned and that was my deal. And I knew I had to get that deal done.
That's amazing. Okay. I'll let Coté. This is a 2-person interview show.
So you went over starting your own fund, you and your partner's fund. But what was the jump from 451 to getting into VC land? Like, do you get like a secret invite? Did you have to have to push yourself in there, or like would a briefing call wrap up and someone was like, you should give me a call later? I got some, how did that happen? And part of that, like, maybe also, I'm asking this kind of question. Maybe also if you could highlight, like, I think, tell me if I'm wrong, but I think one of the characteristics of kind of VC-ery that you have is also someone like Benedict Evans, who like is famous, right? Like who already has like a persona and is out there, kind of like you were saying, right? Which I think not all VCs have that necessarily, right? It's kind of cultivate this persona, or persona is the wrong word, but no,
persona is exactly the right word. I put on on my VC face. It's like a game face.
Well, yeah, I think the reason I'm hesitating is you need something to put the persona onto, right? Like, and that is, the knowledge that you have from having been an analyst and anything. Anyways, how did you go from 451 to just entering the land of venture? Yeah,
so an analyst background is still pretty rare, and I don't think any of us yet has been successful enough to make it a reliable road.
Right. It's still speculation.
Yeah, the others are Mary Meeker and Anil Lakhani, my friend at Crane VC, who I overlapped with at Honeycomb, as it happens. Anil's a brilliant investor, shout out. The analyst experience was fantastic. And one of the things that I did when I left 451 was I pulled all the data. I had covered 1,053 venture-backed companies over 12 years, of which 8 had gone to IPO. So I got to write this really nice sort of analysis of the data and say, like, the numbers that people tell you about how many software companies fail are completely supported by my experience.
Right.
And I still, like, that education is still the core of my practice as a VC. I know how rare it is for companies to break big. And I'm always looking for those outliers and those early signals. All of that said, the transition from vice president of my own software practice at an analyst firm to being bottom of the totem pole at a VC firm was brutal. And it took me a long time to find my feet in venture.
Well, what was brutal about it? Do tell.
It was the hierarchical stuff. I mean, in analysis, like it's not a super lucrative career, but you do get rewarded for being clever and being able to see around corners. And that was why they wanted to recruit me. And to answer your question, Whitney, I was literally at a lunch to celebrate the IPO of Splunk. And I was sitting next to one of the early investors in Splunk. And Godfrey Sullivan, who was the CEO, said, we really should start a Splunk Ventures and do corporate ventures. And I'm like, oh, pick me. I'd love to do that.
Wow.
A few months later, the investor who'd been sitting next to me gave me the secret call and like purchased a subscription to 451 so that he could chat with me off radar. And that's how I ended up getting in. So, you know, it was a classic lean in moment. If you are interested in this, do put your hand up and say, pick me. And people will remember and they will jot your name down on a list. What made it really hard was going from having a lot of autonomy and agency as the head of an analyst practice to having very little autonomy or agency. And in particular, knowing that I was right about deals like Honeycomb and being unable to bring the partnership around for structural reasons.
And so this is an interesting way maybe to find out like what the day-to-day life is. So when what I'm thinking when you're saying that is you are not always, you have an idea of what you want to do. I want to invest in Honeycomb.
Yeah.
And basically you're told no. And you're like, wait, but what? And they're like, no, I don't care. That's the answer. No. Right. And so there's kind of like that you get shut down or whatever, which, you know, that's how a hierarchy works, whatever. But then there's another possibility, which is like, you're told to like make 10 slides that you think is really boring. I mean, there's other people who do that kind of stuff, but is there other, like, when you're at the bottom of the hierarchy in the VC world, do you also end up doing like boring work that you don't want to do? Or is it just that people say no to your ideas?
Well, I don't do boring work that I don't want to do because I'm a terrible employee. Nobody ever hired me. I'm opinionated.
So you just make sure to shit the bed a few times and people are like, I'm never going to ask them to make my bed again.
But there was stuff that I did at that first venture firm that I loved doing and that had amazing repercussions down the line. So we did do one investment that I really loved in a firm called Wit AI, which had just come out of Y Combinator. Alex and Laurent now running Nabla out of France. Wit was one of the very early AI companies. It was voice recognition. And we wanted to sort of galvanize a movement around, you know, all of the amazing stuff that had been happening with voice assistants like Cortana and Siri. And so I said, why don't we do a conference? And I just like rolled out the analyst conference playbook with the guys. We got Adam Cheyer, the creator of Siri, to come and talk. And it was a wildly successful event, which totally backfired on me because it got Whit onto the radar of Facebook, which acquired the company to become the core of Facebook AI research, which the firm considered a very disappointing venture outcome, which it was, but like led to my being involved in AI and connected with Facebook AI research 10 years before it was cool. It was still very dorky back then, but that turned out to be a huge win for me, because when we did do Honeycomb, and I had to leave that firm and join another firm to do the Honeycomb deal. When we did do Honeycomb and we were trying to do the same thing around observability, I was the convener of the first OliCon down at the Pearl in Dogpatch, and we ran the same playbook again. And it was about bringing together everybody who was interested in the space and getting them into a room and arguing about what observability meant and why it was important. And that was one of the, I mean, I cannot in any way claim credit for Charity and Christine's success, because that company was going to be a monster whether I was involved or not. But it was wonderful for me to be able to bring that experience to contribute to Honeycomb's success.
So it seems like, and of course, right? Like there's several things from the analyst world that you took with you into your VC playbook. Like, yeah, like I think you were in the analyst world a lot longer than me, but you do enough conferences, you're kind of like, this is how you do a conference, right? I mean, maybe I don't know how to make sure the donuts show up on time, but I know what it's supposed to look like.
Yes,
and like all this kind of stuff. And like, so doing that in reverse, like when I I think this is what happened. As I was telling Whitney earlier, I think you kind of like recruited me kind of accidentally to take over your job. Like,
yeah.
I think, I forget which hotel we were at, but I was in some hotel and we were talking and you're kind of like, you should try this. And so that was fun. But
I already had one foot out the door. So I'd been thinking about, because I loved 451. I love all my friends there. I'm super glad it's still successful. I did not want to leave them in a hole. And so I was thinking, who can I ask to step in and lead the practice that I built? So I was thinking.
Scheming, looking around corners, as it were. And so all of that is one, just to talk about myself, which I love doing, and have someone co-talk about me.
Interesting.
But that's all to say, like, one of the first things I saw when I started there is you had written a template, a guide for how to write a 451 article, right?
I'd forgotten that.
Yeah, it was great. It was like, I don't know, 7-8 sections with a little explanation of what's in there. And of course, it had the best lesson for analysts ever. When you ask them who their competition is, do not accept the answer, we don't have any. Like, which is great. But my whole point in getting to that is, so even though you've forgotten it, but thinking about the work that you did and the way you covered stuff, like if you went back and told analysts or advised analysts like how they should cover companies, now that you've been a VC, like what do they usually miss out on? Like what are the things that would be valuable?
Oh, that's
you can
really
decide who
question.
the audience is, but like not necessarily valuable for more VCs to want to subscribe to 451, but more just to get like reports out that you would think, oh, that's a good write-up. Like that's a good report. Like what do analysts miss that you see in the VC world?
That's a really good question. And it's funny you should ask, because I just ran a bunch of sessions for HeavyBit, another venture company, training their portfolio in how to engage with analysts. And of course, the analyst world is changing dramatically right now. Gartner came out with its quarterlies and absolutely tanked its stock price. That touches on a whole bunch of very big topics. So I will refocus it to say, if you believe that humans have critical thinking that machines don't, and that LLMs are not going to develop because they're not world models, they're just text models. If you believe there's still value in finding the people who can see around corners and giving them the resources to keep doing that, then there does need to continue to be an analyst industry. At its most cynical, it's cover your ass for IT managers making $1 million purchases at big banks. At its best, analysis is a forum for the most intelligent conversation about the industry, not only what it is, but what it could be and where it should go. The kinds of insights that meant that I knew Honeycomb when I found it. So my advice to analysts would be, number one, fight hard to position generative AI as an augment to your practice, not a replacement for it. Because all of your managers are going to want to fire you and replace you with tools, which is ridiculous. Like, the tools don't even care what human wants. Like, if all we have are software tools advising software tools to buy software tools for software tools, then like 3 people in the world get all the money and the rest of us starve. And this is not a future that I am working towards. The tools are there to serve humans. The tools are there to free up enough time that I can get down to the barn and ride 2 horses in the afternoons. That's what they're for. They're for Rachel's horse time. So think about how to use the tools to streamline surfacing interesting leads for you to talk to streamline scheduling, which used to take us hours, and now you can just like shoot over a Calendly link and suddenly it's effortless. To streamline note-taking, shout out to Granola, which has absolutely transformed all of the conversations that I have by letting me keep a record, including the action items at the bottom. So every Monday morning I can go through and keep all of the promises that I made last week to introduce people to people or to send people documents. Make it clear that those tools are in the service of a human mind, and that the human mind's job is to do the things that the machine can't do. So the way the text models work is they predict the likeliest next word. Mm-hmm. And what humans are great at and what value comes from is the outliers. It's the unexpected connections. It's the stuff that's not mid. As good as it is, ChatGPT is only ever going to get your prose to mid. Everything above mid, mathematically speaking, has to come from a human brain right now. So double down on your human brain, sharpen up your critical thinking skills, make sure you know when you're being bullshitted at, and touch grass.
I love that. I have a question. You mentioned earlier in the podcast about how most investments are going to fail.
Yeah.
And I'm really curious about how failure is built into the whole VC system. And I imagine you almost want to fail sometimes because that's how you know you're pressing the boundary of what's possible. If you never fail, that's a bad thing. You're being too safe.
Yeah, it's a big question. VC, as it's currently constituted, is predicated on power law outcomes. You invest in 100 companies, and one of them is a 10,000x return. Mm-hmm. And that has worked well historically for the last 20 years, particularly for funds in the sweet spot of like 50 million to 250 million. That logic is starting to change, and change pretty radically over the last 5 years. So last year, 9 firms raised 70% of venture capital. And these are monstrous firms. These are firms with billions and billions of assets under management, fund sizes that are $1 billion. To get that 10,000x return, you're talking about $1 trillion companies. There aren't that many of them.
Yeah.
Meanwhile, down the other end, emerging managers are creating more funds than they ever have before. And these funds are tiny. My fund is tiny. It is way, way easier to get a 5x investment return on a $5 million fund than it is on a $5 billion fund. There's just like a lot more room to multiply the value of those companies. So it's still the case. It's even more the case that some of these small early stage fund post the highest returns.
Oh.
While the big funds are like holding back on IPOs because the public market is not going to reinforce the late stage private equity valuations that have been loaded onto some of these companies. So even their IPOs are likely to be disappointing. And so you're seeing companies stay private longer and longer, almost in a pyramid scheme where the investors are looking for the greater fall to mark up these investments.
They're like too big to exit. Like
they're too big to exit. Exactly.
So another thing. Oh yeah, there it is. I lost my question on the ground. So do you think like So now that you've been in VC for a long time, and I'm sure you still do, and you encountered many like private equity people, are they just like opposites, or could you swap those two roles together? Like, is
No,
it
not
a
at
different
all.
skill
Not at
set,
all.
or like, is it like you're like, see the PE people coming and you're like, I gotta go. Like what's the relationship between VC and PE people?
So this is fascinating. It's something I've been thinking a lot about. So I love super early stage venture. I'm temperamentally ideation, team, and vision. Let me write the first check investor. And that kind of should be value neutral, and I wish it were. But there's a truism in venture that fund size dictates behavior. And you see this so often. The small funds, we're scrappy, we compete, we have sharp elbows getting into deals, but we're fundamentally, our interests are very much aligned with those of the founders because we're getting in very early. We want to build companies. A lot of us are operators. All of us are nerds. We're all shiny. That behavior really starts to change when you get to about 100, 150 million fund size. At that point, rather than being highly incented to seek outliers, there's a lot more incentive to bet on sure things. So your bets start to get more conservative. You start to be a lot more conscious about what the other venture firms are doing. You start to be a lot more paranoid about what the other venture firms are doing. Sometimes your interests are not going to be super aligned with the CEO founders. That's the stage at which, like, when you get to Series B or C, you're having terrible conversations with the founders saying you're underperforming and we're going to have to fire you. That's still like very much venture land, but that trajectory takes you ultimately into private equity land. And like, I have great friends in private equity. There's like an incredible business happening right now, buying up very successful like chains of laundromats or dry cleaners from retiring baby boomers and driving a lot of profit through simplifying chains of those businesses. There's also, as we all know, a thriving business in enshittification, as evidenced by the fact that private equity came into vet care. And so all of our vet bills have 10x'd over the last 5 years. There are ghouls at every stage of the investment pipeline. There are ghouls in every walk of life. But the fundamental premises of private equity of like, now you have an oil well that's throwing up money and you have to preserve that oil well at all costs until it runs dry. It's a very different attitude from early stage venture. And I would go even further and say all of the venture industry that we've been describing up until now has a lot of similarities with the fossil fuel industry in that it's assumed that talent is densely concentrated in a handful of places and can be monopolized. I would argue that the generation of venture firms coming out of VC Lab, all of us very small fund emerging managers who are very atypical and come from much different backgrounds from the traditional venture funds, are more like solar power. And we believe that talent is distributed all over the world and that it's infinitely renewable and that capturing it shouldn't be enormously damaging. So I would say I'm a solar punk investor and that private equity is the extreme of the fossil fuel industry.
It's sort of. I mean, you were making me think to make it cutesy. Like if the VCs like write the first check, the PE people cash the last check.
Yeah,
like they're on different sides of the spectrum.
Yeah, and I back to your question about failure, Whitney. I'm hopeful that the solar punk model of smaller, earlier checks and being more founder aligned, combined with all of the new tools that we have that mean you can get to $1 billion in revenues with a staff of 10 people, mean that we'll have less failure. Because if you're writing a $50,000 check and you have a Wit.ai scale outcome, they sold for a bit over 10 million, I think. That's a wild success. Like if I invested at 1 million and they sold at 10 million, I've got 10x, yay me. If I invested at 10 million and they sold at 10 million, I'm a sad little bunny. So smaller checks earlier, more highly leveraged founders, more founders. I'm really hopeful that we'll see more success.
This feels like the phenomenon innovator's dilemma, where the big companies just aren't agile enough to adapt to new trends, and it allows little companies. So this is that, but it's kind of meta because you also invest in the companies that are trying to be disruptors.
About the innovator's dilemma.
Exactly.
So you have all of these operators, Mark Andreessen again, who came up young and scrappy and was like, we're the underdog, we're fighting, and now he rules over this like empire of capital, and surprise, surprise, his opinions have shifted very significantly from the Gen X upstart that I once knew.
Well, related to that, like, even though you have tastes like architecture and horses, as you're saying, you didn't grow up, smelling money in the morning just because it was left everywhere. But like, do you catch yourself every now and then being like, oh yeah, they sold for $10 million, and you're like, oh, holy shit, $10 million. I wish I had 10 million. Like still thinking like that's real money, right? Like it's like, or do you notice? Do you sort of just like, and I don't mean this in a bad way, but do you recalibrate at some point and you're kind of like, right, money is like this fuel that runs through things and you get access to it and things happen with it, or not? Or like, how is your thinking about your own relationship with money changed over the course of this stuff?
It's such a good and deep question. And I really believe we don't talk about class often enough in our industry or at all. Again, Charity Majors just published a really cool thing about growing up poor. And, for all that I throw a lot of arrows into the tech industry, it has been absolutely transformative for me. Like, my kids have grown up with an abundance that I could only dream of. And I'm super grateful for that. And I'm not like wildly successful by any imagination, but the material resources that I have are so much greater than anything my mother could imagine. Like, and let's multiply gender into that. So my mother, as far as I can determine, was the first in her family to go to college at all. And she had a nervous breakdown and wiped out, because like being the first in your family to go to college is hugely traumatic, and in the 50s was particularly under-supported, and it was not at all surprising. I have 2 degrees and a successful professional career. I mean, I'm growing to look more and more like my mother. And one of the ways in which that's wonderful is that I feel like I'm granting some of the wishes that she was never able to fulfill in her lifetime. She loved animals as well. She would have loved to have 3 cats and 2 horses and be raising guide dog puppies. And so every day I'm confronted with, like, I ended up with a totally different destiny from my mother, with the same like natural wits and ability, and just with much different circumstances and much different opportunities. That, as you can tell, is absolutely central to my investing thesis. Like, my mother, in a different set of circumstances, could have done what I've done easily. And so everyone I talk to with a different set of circumstances could be doing extraordinary things. I'm a huge believer in the world not being a hierarchy, but a network. And the secret to a fulfilling life is to find your node in that network, to find the thing that you could uniquely contribute to the world, and just double down on that, lean into your weirdness.
I love all of this, and I relate. I want to ask about founders. So you're talking about like seeing through the circumstances of your founders, right? And you're also talking about having a good idea. And I guess I'm wondering, how much is the idea? How much is the person? How much is the ability of the person to be like a salesperson and a storyteller? Like, how much is this?
It's such a good insight. We call it founder market fit. We talk about founders scratching their own itch. We talk about founders who have deep domain knowledge. I mean, I actually call it out in our founder rubric. We're looking for somebody who can articulate a contrarian point of view and become the human representative of a large class of customer problems. It's not about your solution. It's that you care incredibly about fixing this problem.
So if someone has an absolutely incredible idea, but they maybe can't articulate it or kind of boring or whatever, then it's not a fit. It has to be both the person and the idea.
I mean, at the stage that I'm investing, yeah, it is the founder, but like convincingness comes in all kinds of guises. I don't want to get too specific about this because it's super critical, but you can imagine a founder who's a little bit shambolic when they're pitching to VCs, but when they go into, and I'm talking about several different founders who have been enormously successful, so don't take this as criticism. You know, they're not super electric in front of VCs, but when you get them in front of a crowd of deep nerds who really care about that problem, and they have like this amazing intuition about the correct way to structure these problem solutions, the sales go nuts. And the VCs are like, this person didn't go to Stanford. Why are they getting this ARR? And it's completely obvious if you ever see them interacting with real customers. It's just a charisma that doesn't translate to the boardroom.
How do you get that knowledge? How do you see them in front of other nerds and real customers?
You go along on customer calls. What, like it's hard? I mean,
I don't
get
know.
out of your cushy office on Sand Hill Road and you like go and...
I'm considering investing in you. I'm going to be your human shadow for a few days. Yeah.
Why wouldn't you?
I think that's great. Yeah.
You're reminding me of something I was thinking as you were going over analyst things you would suggest analysts do. And I mean, it's like from what you two were saying, there's a lot of, in a good way, what would you call it? Like subjectivity of like getting to know a person involved in what you're doing. And maybe in the analyst business that happens person to person, but there's not like a 2x2 diagram of that shows up, right? Where when you're writing an analyst report, it's not very common where you're like, yeah, but this team is really awesome. Like they're, or like they've got this character, or like, even coming up with some criteria. But I don't know. I mean, have you encountered that in the analyst world? And like, would that be helpful? Like, would you trust the analyst world to like say like, ooh, charity majors going places? Look at this. Whatever.
Yeah.
I don't know. All our sort of characters.
No, that's really interesting. You're right that those intuitions didn't show up in the written research very often. But this is why people get on analyst calls. Like this is why we would go to events and our day would be booked out with 16 half-hour meetings. And those days used to give me nosebleeds until I sort of shifted my perception of them and realized that if I could figure out one thing that each person wanted that I could grant them, if I could figure out one wish, and, it would be an introduction or a perspective, then I could get through those days and those interactions would be much more positive. And then again, that flows into how I approach investing. Even when people pitch me and it's a no, I try to figure out something that I can give them, like whether it's a referral to another investor or just saying, actually, your deck sucks. You might consider changing this. All respect. Like I know how hard it is to be a founder, but I've seen 1 trillion decks, and this simple change could make a major improvement. Yeah. So it's switching from I am the Lord high powerful, I am speaking down to mere mortals, to you and I are having a conversation and we're trying to exchange value and we're trying to build a relationship. Because I've had people pitch me and then come back a year later with a different pitch and I'm like, yes, that's it. I'll invest immediately. And those are the relationships I want to build. I want founders that I reject to put me at the top of their list when they go out again.
You said you've seen 1 trillion decks. You've talked to a lot of founders. Do you feel jaded? Are there moments like what still excites you after you've seen 1 trillion decks?
So my kids laugh at me because I still do the admissions for Alchemist Accelerator. So I'm looking at like every few months I have 400 decks and pitches that I have to go through. And they'll make fun of me because like, oh, Mama's judging startups again. And one of the kids, and like, we scrub the identifying details. It's all held in great confidentiality, but they're watching over my shoulder and they're like, this startup's not a fit. This startup's not a fit. it just happened that I found one, and I was like, and the kids watching me, they're like, this is a really good idea. And I'm like, yes, that's why I keep doing it, is that everyone's doing their best. Everyone's got ideas. It's really hard to find the place where your idea will fit. But like, I'm looking at 100 applications to Alchemist, and this one's great. This one's going to benefit enormously from the program. This one's going to become a really interesting company. I know exactly how to help and who to introduce them to. Like, yeah, it's a big forest, but there are amazing mushrooms in here.
I love how excited you are just talking about how excited you can get. How far along are these ideas? Are they like a twinkle in someone's eyes? Are they like pretty built out? Like,
all different stages. Like, there's a new thing of companies going into YC with like having already raised 6 million or having like 2 million in ARR, which is kind of amazing. But that's because YC is morphing into more of a platform for like pre-qualified investment opportunities. At Alchemist, it skews a little earlier, so it can be anything from a nascent business to a twinkle in someone's eye. At Generationship, my fund, we have been trying to get earlier and earlier because I believe we can have the biggest impact if we are the first check-in. So we just signed our first 2 checks in. So yeah,
what's check-in mean in this context?
So someone is thinking about leaving their job. I'm a menace to society. I'm saying, do it, make the leap, incorporate your startup. And then when they've incorporated, they send me a document called a SAFE, which was developed at YC, which is a simple agreement for future equity. And I sign the SAFE and I wire them money. And so I'm the first money in the new company's bank account. That's what the first check means.
And so you're the check-in.
Yeah.
The first check-in. Okay. Yeah. Amazing. I'm learning so much. So if you're a regular person with a startup idea, what like, and you know nothing, like what's your first move?
Read everything you can. Like, there's so much online at the moment. YC has a free program called Startup School where you'll learn a lot of the language. If you're a person who reads books, as I am, Steve Blank's The Startup Owner's Manual has been around for 12 years and is still like the gold standard for understanding an early stage startup as a science experiment that's prospecting around looking for its oil well of value. That was a mixed metaphor. Brad Feld wrote a book called Venture Deals, Be Smarter Than Your VC and Lawyer, which is another essential reference. I'm also going to shout out Cindy Alvarez's book, Customer Development, Lean Customer Development. Cindy is a friend and another Alchemist mentor. And she sort of expands on what Steve Blank's writing about and saying that this intimate relationship with your users, the ability to understand and anticipate how they want to solve problems, is really the engine of all software startup success. And she actually has like scripts for how you can do it, how you can go and talk to your customers and find out what they're thinking.
That's amazing and so helpful. So I love books so much.
I love books. And like, you can get all of these on audiobook. And if you're me, you listen to them at 1.25 as you're driving down to the barn. And yeah, it doesn't have to be like studying for your finals. It's more like listening to a podcast. So
you talked about different types of VCs and private equity. You talked about different types of VCs in terms of like you're super early stage and there might be other VCs that are trying to get on board later. But are VCs very different from industry to industry? Like, you seem very specific, like AI and infrastructure. Are they usually that specific?
Yeah, so the lingo is there's generalist and specialist VCs, and I'm very much a specialist VC, but I'm in a segment that's actually, the software tools I invest in are very broadly applicable to anybody who's building software, but I'm defined as a specialist VC because I do software infrastructure. There are generalist VCs who invest across tech and healthcare and financial services. I would say that the biggest difference in specialization is the they call it wet versus dry biotech. So Jenny Rook, who's a friend, has a biotech investment firm, and like that's highly, highly specialized. And getting through the FDA and understanding how to run wet labs is like its own whole discipline. And so that's a very discrete specialty. But then there's health tech companies, which might be primarily software, which would fall under a generalist software investors area. There are so many differences between us all. Like there's a real distinct community of us that love infrastructure and early stage, and we all kind of know each other and share deals. There's the blockchain guys who are their whole separate breed. Many of them are women, but like I've never touched blockchain and I never will.
I have a stereotype that's tech bros. Is that a...
Yeah, and there are women tech bros as well.
Okay.
But it's very line goes up, you know, it's very we're all going to make it, which is laudable in its way, but different from how I think about the world.
And do you think like as people you're different VCs that specialize in different things or different types of weirdos?
Yeah, I mean, in my space, there's a lot of coders, there's a lot of technical people, engineers. In sort of more broader generalist stuff, there's a lot of people from financial backgrounds, people who'd worked at banks, people who'd gone to big East Coast universities. It's a little bit more sort of business formal. When you get to private equity, it's like super high end. I mean, I'm talking more and more to the institutional LPs who are limited partners who invest in larger scale funds, and they can be like college endowments or the family offices of high net worth folks. And even they're like all on a spectrum. Like you meet people from Laureen Powell Jobs group, and they're quite different from the people who are running the Yale endowment. I mean, people are just people. The cultures vary a lot. I'm considered like very Wild West by a lot of the sort of starchy East Coast firms, but I'm pretty normal by California standards.
So what does that word culture mean in like kind of VC and startup land? Like, I'll stop myself from answering my own question, but what does it look like when people say that? How does it manifest itself?
Okay, so there's this slightly sloppy way I was using it just now, which is really like the dress code for conferences and the kinds of questions people are going to ask you when you do one-on-ones. There's a much more specific meaning that culture has in VC, which I can oversimplify into an argument that's going on right now between the Y Combinator sort of founder mode, 966, death grind, you've got to be working all the time mentality versus people are humans, and humans work their best when they're in an environment of psychological safety. And if what you're really trying to do is put together teams of humans who will create more value than they consume, then psychological safety is a really powerful way to enable that. And right now, like, clearly the grind culture is winning, but I'm fighting a rearguard action and saying I do think humans should continue to exist because some of them are my friends, and burnout is not really a sustainable strategy.
I don't know. I think you've got some bias.
I may yeah.
I have one last question. I love hearing a failure story. And since failure is like a natural part of what you do, please tell me a time where you thought something was going to be amazing and it
Well, I have to say, I never thought it was going to be amazing, but I dropped into a portfolio company as the VP of marketing, having never done marketing before. That was just decided that since I had an analyst background, I would obviously be a good VP of marketing. And I had a very dear friend come, like, as I was trying to get my arms around everything and look over all of the materials and give me some advice on how to be a good VP of marketing for this startup. And he looked at it all and he's like, "Oh, Rach, you've been set up to fail here." I was like, no. I can like, I'm a honey badger. I can work my way through this. I can do this. And just like grinded my utmost for the next 9 months trying to market this product. I'm not going to name names, but the customers hated it so much. They had a pet name for us that rhymed with the name of the company, that described how painful they found it to use. And I was eventually fired as VP of marketing because we had run through $5 million and we had 0 customers. And 2 months after I was fired, the company wound up its affairs because it still had 0 customers. This was a founder who'd been very successful in another field, had transferred to this field, had done absolutely no customer discovery at all, had gone and talked to a bunch of very decorated experts in the field and created a product that they thought the market should want. And the market sent back a very loud and clear raspberry.
So someone looked over your shoulder and said you're set up for failure at the beginning. What were they seeing that you didn't yet see?
The complete lack of conversion. Like we were getting lots and lots of people to try it and everyone was churning out.
So now you would recognize the warning signs. Yeah.
But I'm still really tight with the person who said that, and I am no longer in touch with
the others.
Yeah.
So have you like developed a sense for when to like shut something down? Like even if you like it, like how do you develop the sense of like, we're not going to, what's the phrase? We're not going to throw good money after bad. Like when do you kind of call it and just stop doing something?
It's hard because given the checks that I write, it's not my call. I have. All right, I'll be actually really honest in this. I do know when stuff is going to fail. I usually know before the founder does. I will say this is not working when it feels appropriate, because what I'm optimizing for is not sparing the founder's ego, but giving them an environment of psychological safety in which to fail. So I'm not interested in twisting the knife. I'm not interested in like forcing them to face facts before they're ready. I will tell them things that I think are true. I will tell them, what is my weighted prediction of the likelihood of them raising the next round. But I'll typically let them exhaust every avenue themselves because I don't know everything. I've been wrong. But then it's actually really important to me to show up for that founder when everything's going to shit. And that can be really hard. And sometimes you're on the phone and somebody's crying and you just have to be there and hold space for them. But it's part of what being a decent human is. And again, the mercenary point of view is I want to get first crack at that founder's next project because they're going to have all of that education that somebody else has paid for and they're going to be much better at it next time. But also, what are we doing any of this for? We're doing this because we show up for each other, because we're trying to make cool things and we want to be in a community.
This is I think I had some bad preconceived notions about VC stuff going into the show.
I'm actually not a typical VC.
So I had not considered the emotional side to failure, and especially for the founder. You're used to it, I imagine, and don't feel terribly emotional.
Oh, I do.
But for them, it might be their baby. Oh, you do too. Okay, you cry together. So I guess
that would be I dump out. I'm there to support them because they're at the center of the crisis. But yeah, I've cried over startups that I thought should have succeeded that didn't.
Sometimes you imagine it's just all the ingredients were there, but the market just happened to go another way.
Yeah, and those are the only failures that should happen. So again, back to your question about failure, because this is a huge topic. You're going to have some inevitable amount of failure because by the nature of startups, we're trying to create new value where none existed before. We're pushing the boundaries. We're doing searches of the problem domain to find new information. There's going to be a lot of negative results. It's a scientific experiment. You're going to get a lot of negatives. You're going to have hypotheses that don't pan out. That's part of the process. That failure, I would argue, is healthy and good, and it teaches founders a lot about what to do next. And a founder that's been through that kind of failure is better equipped. Unfortunately, the prevalence of that kind of failure has, I think, inured a lot of people to the other kinds of failure which should not happen, which are, boards making bad decisions, boards kicking out very effective founder CEOs because of personal conflict, boards appointing their friends to very highly paid positions in the companies, and those friends in highly paid positions do a terrible job and waste a lot of venture money. I've seen all of these things happen firsthand. There's a lot of manufactured failure that comes out of incompetence and, frankly, corruption in the industry that's tolerated because the science experiments that don't turn out also fail. But there's a big difference between those two failure parts. And honestly, VCs don't take enough responsibilities for the failures that are their fault, and they should.
It sounds like one could segment responsible failures versus irresponsible failures.
Yes.
in between those two.
One last question. You've talked a lot about all the different things you do, and it seems like you wear a lot of hats. Like, what's a day in the life for you?
So my preferred days are, I stack a lot of meetings in the mornings. So, I'm quite often on calls continually from 8 till 1. And that'll be a lot of fundraising. VCs are always fundraising. A few pitches. I try not to do more than 2 or 3 pitches a day, because after the third one, I do start to get cynical. I do my own podcast. So I'm trying to do an episode every week or 2. I appear on other people's podcasts a lot. I do a lot of calls where I'm like career counseling people or meeting people for the first time because they're looking for a job and I have a lot of connections, or, hashing out ideas for startups that aren't even real startups yet. So I have like 1 or 2 of those calls a week. So ideally I wrap it all up by 1-ish, go out and sit in the garden with my cats and decompress and have a bit of lunch. And then I go down to the barn and I ride Lenny and Bailey, my Mustang and my quarter horse.
Sounds great. Sounds like a wonderful day.
It's not bad.
Well, speaking of things that aren't bad, thanks for being on the podcast. That was a good conversation. It was fun to chase little things around here and there. And, maybe the only context outside of like Dungeons and Dragons where I will encounter the word centaur this year. We'll see. I don't know if it was ever a popular word, but
it's coming back as people think about how to harness AI. Like the centaur is actually a really powerful image for you've got this incredible automation and you really want a human to be in charge of it.
Yeah. Maybe you should name your next fund the Centaur Fund.
I like generationship. For those who don't know, a generationship is a colony ship that's on a very long interstellar voyage, such that multiple generations of humans will live and die on it. And I love the name because it talks about generative AI and it talks about different generations being in relationship with each other. And of course, the first generation ship is Earth, and we're right here.
Indeed. Well, so where would you point people to if they want to check out your stuff, what you're up to?
Yeah. If you want to talk further, I'm Rachel at generationship.ai. We have a somewhat vague by design website at generationship.ai. We're hoping to launch formally in a couple of months. I have my own podcast, which you will find by searching on Generationship, wherever fine podcasts are broadcast. I will be at RustConf and NeurIPS down in San Diego. So if you see a middle-aged Australian woman with short grey hair. It's probably me. Say hi. Or come to the barn. Give the horses a carrot.
There you go. Now, do they like apples? Am I wrong in that?
They
Or is it all
love
carrots?
apples. And I get the Frog Hollow farm subscription box. And right now it's got these huge peaches and we don't get through all of them in a week. So Lenny the Mustang has developed a taste for fresh peaches, which is...
Is there like a plant thing that a horse won't eat?
Different horses like different things. Lenny weirdly dislikes watermelon rinds. Nearly all horses love watermelon rinds, but Lenny turns his nose up at it. He was born a wild stallion in the California deserts, and now he's like, no, I prefer this fruit to this other fruit. I can't work under these conditions.
I'm going to be in California next month. You might find me knocking on your doorstep.
Just don't bring your watermelon rinds.
Don't bring no. The other horses will eat the watermelon rinds, but not Lenny.
Well, great. Well, thanks for being on. That was really fun. And if the listeners want to check out more, you can go to softwaredefinedtalk.com/108, and we'll put some links to things mentioned here. Probably not links to everything. Also, you can, if you go to softwaredefinedinterviews.com. That's the other podcast. But if you go to softwaredefinedinterviews.com, you can join the Slack channel there too, where we talk a little. There was some action in the interviews channel, right, Whitney?
Yeah,
stuff happening there. But there's other stuff about the broader software defined podcast world. And with that, we'll see everyone next time. Bye-bye.
Bye.
Bye. Thanks for having me.